The stock market plunged, and many investors were tempted to pull their money out of the market and avoid additional losses during the COVID-19 pandemic. Your ability to stay calm and stick with your plan during the market's inevitable ups and downs can have a big impact on your investment returns in the long run. Here are the 5 best practices we've found for long-term investing that can help you stay the course and avoid costly mistakes as you pursue your financial goals.
Perfect.
The first best practice is to understand your risk tolerance. Risk is a part of investing, and it's a necessary evil, if you will, and temporary market declines can happen, even outside of the global crisis of COVID-19. So building a balanced out allocation that factors in your risk tolerance can make it easier to stick with your plan during challenging market environments. In turn, you'll likely avoid the emotionally driven decisions and panicking and selling when the market drops. The second guideline is to embrace diversification. Once you determine your risk tolerance, diversifying your assets can help reduce the chance that performance of any particular investment can have an outsized effect on your portfolio. For example, let's say your portfolio had 5 stocks and one of them underperforms or performs really poorly. Your portfolio is going to take a big hit with that. The third rule we like to say is that rebalance as needed. Market shifts can have an impact on your asset allocation. For example, your stocks may balloon during a stock market rally, exposing you to a lot more risk overall than you had planned. So be sure to rebalance your portfolio so that it stays at the same risk. The fourth guideline we have is to avoid trying to time the market. We all know it's not a good idea to time the market, but it can be tempting to consider pulling your money out of the market when the market takes a setback, and doing so can really hurt your investment returns in the long run. The recent pullback is a great example. Market downturns are notoriously hard to predict. I'll admit I didn't predict this recent market downturn. But market rebounds are also notoriously hard to predict, and you don't want to put yourself in a risky position. And then the fifth is remember your allocation when you get these big swings, and remember why you made these investments in the first place. They'll help you reach your goals, and that'll help you stay disciplined and focused. If the best practices have you considering how your investments have just been handled through the COVID-19 crisis and fast rebound we've just seen, give me a call. I'd be open to a conversation and see if there's some ideas that might help you.